Hello, everyone. Thank you for joining us for our webinar today. I'm really excited to present to you some of the things that we've been working on here at CUCollaborate. Just a couple of housekeeping items before we jump in. We are recording today's session, so you will receive a follow-up email from us with not only the recording from our webinar, but also the slides that Coco will be presenting on today. And of course, ways in which you can reach out to us and connect with us after the fact if you have questions for us following today's session. Speaking of questions and comments, would love for you to interact with us today via our chat and the Q&A section of the webinar. Feel free to drop in any comments, questions, etc. Into either one of those forums. We will be monitoring both the chat and the Q&A section, and we'll be facilitating kind of an open Q&A section at the end of Coco's presentation here in a moment. For the sake of time, we're going to go ahead and get started. The last thing is we'll keep you muted on your end. If you do want to make a comment, we can unmute you at the end. But otherwise, I'm really looking forward to having you on today's call and connecting you with our Director of New Business, Coquise Frost. Go ahead and take it away.
Good afternoon, everyone. Feel free to call me Coco. That will probably be a lot easier than trying to say Coquise. But I'm super excited to go through the credit and growth playbook that we've created here at CUCollaborate using a ton of data and just experiencing helping credit unions look at growth levers. If any of you were at the America's Credit Union Strategic Growth Conference in Cleveland this year, this will be very similar to what I presented on at that conference, but I'm excited to expand this to a wider audience and just as we look at strategic planning season, get this into all of your guys' hands to use as you guys embark on those conversations and those sessions. Okay. For anyone that is not familiar with CUCollaborate or is not a current client of ours, just at a high level, CUCollaborate is a CUSO that aims to deliver outcome-driven analytics through our software, while also pairing our deep consulting expertise in the regulatory landscape for credit unions. And we are constantly aiming to understand what's changing in the industry, what's impacting the industry, and how can we arm our credit union clients to act on those changes. And we constantly see evolution in the regulation landscape, whether it's with the NCUA or if you're a state charter with your state charter regulator. And as different funding opportunities and operations shift, we're here to help any of our credit union clients navigate that. At the end of the day, CUCollaborate is what I like to call a data collaborative. We have a network of public and non-public credit union data, and also our consulting bench with a lot of credit union expertise. We put together call report data, your areas data, geospatial data, and loan origination data that all helps us deliver really amazing results in credit unions that are looking to expand their field of membership, looking at member eligibility friction, looking at CDFI, low-income designation, inorganic growth, or branching strategy. So if these are things that are on your radar, definitely feel free to schedule time after the session and we can dig into the specifics around your credit union, what you're looking at. But what we're going to focus today around is looking at the strategic problem within the industry, looking at the big shift, looking at a five-step framework we've created, looking at closing the perception gap, retention and culture as a really great growth lever that everyone can look into here today, regulatory accelerators, and then just the hierarchy takeaway. And then again, we'll address any questions or comments in the chat when we come to the end. So I always like to start with just acknowledging that running a credit union has just recently gotten harder. When we look at the movement and we look at the peak at 20,000 credit unions to where we sit at the close of last year, which is now 4,287 credit unions, and we only saw 3 new charters granted last year, we are in a very interesting place with an 80% decline from that peak to where we are today. And these 6 themes are just consistently what we see as making it harder for credit unions to operate. We've had legacy technology and credit unions making big investment in digital banking and moving into more modern tech, rising operational costs, recently with interest rate volatility and inflation, regulatory and compliance burdens, whether you're federally chartered or even on the state charter side, looking at, post-COVID world, the disruption with said relationships and how we're, repairing that post-COVID, and then struggling to gain a lot of traction with the Gen Z generation that is now entering the workforce, starting to bank with institutions. And we, as anyone, maybe some of you have looked at this, but for everyone's awareness, we run a credit union perception report. And a lot of the data that we're pulling from is from our 2026 consumer perception report that we ran at the beginning of this year. And, what hopefully is not a surprise to people, but consumers do like credit unions and have a very positive view. We saw 3 and 4 rate a positive view on credit unions, and we only saw 5% negative view. And then when we look at, this very positive perception of that, who's actually banking with a credit union and choosing to bank with a credit union, that was only 1 in 4. So only 25% are actually choosing a credit union. And of course, we see the rest go to banks or regional banks, and then looking at fintechs. So what we're seeing is the growth problem isn't necessarily a perception problem, well regarded amongst American consumers. It's looking more closely at the credit union fit, friction, and focus. And these are actually things that, as an industry at your credit union, you have more control over than if it was a perception problem. And that's what we're going to dig in here today. So one of the things that you'll see kind of woven throughout this presentation is the move from trying to be everything to everyone, and that not really being the strategy that in this next decade we would want credit unions to focus on. We want people to focus on picking a niche, understanding who your ideal member profile is that I will define in an upcoming slide, and building a business model around who you serve really well, and refusing to move away from that or apologize for ultimately who your fiduciary duty is to, which will be to that ideal member profile. And so when we're thinking about switching our focus to the ideal member profile and understanding who that is, when I'm meeting with credit unions, I have a lot that come into conversations around growth with, we have these products and services, who can we ultimately market them to? And then let's just expand as broadly as possible and reach as many American consumers as possible. And then when we pull up and look at the results of those types of expansions, you typically will see thinner acquisition, you'll have flatter margins, and there's not this like reoccurring theme or focus around who we're best suited to serve. And then switching our thinking to, who do we uniquely serve well? Do we know what that demographic is? Where is the overlap of profitability and being beneficial, right? Like that ideal member profile for each of you has to both be profitable for your credit union, but you also have to offer immense benefit to that member profile. Again, this dance that we have to dance in the credit union movement of mission versus margin, and how do you find the people that are both profitable and beneficial to you? Then we want to build the field of membership around who that ideal member profile is, build the branching strategy around that, build the marketing around them. And then on the flip side, the results of that is much more durable acquisitions, defensible margins, and having that real focus on the niche that you serve uniquely well. How do we get to looking at this process, and how can we fit this into a framework? Well, it really takes about 5 steps. Order is really important. The way that we've mapped this out, just in my experience, I have people that will come maybe at step 4. And, if we haven't started in step 1, I'm going to force you to go back to step 1. The thing that is most important to do initially is defining who that ideal member is. Then you want to look at sizing the market. So looking at your total addressable market, looking at your serviceable addressable market, and then looking at your serviceable obtainable market, and to understand, potentially, is my current field of membership maybe too narrow, or is there, have I maybe already served it very well, and we actually have a really good ideal member in there, but now we need to find where that ideal member is outside, because we've already had a high field of membership market rate, and we need to start potentially looking at if we're seeing a growth and plateau or growth plateau, where can we replicate that? Then of course it's going to be locating, well, where are these members actually located, the ideal member profile? Are they again within my field of membership? Are they outside my field of membership? Or again, if we're looking at the size of the market, you already have a high field of membership penetration rate. Okay, well, where do they exist outside of where we've historically served really well? And we need to look at how we can expand into that market. Number 4 is actually around the field of membership and the charter type that you have. We need to make sure that you can serve them and that you have a path to eligibility to meet and serve those ideal member profiles. And then of course, marketing. So building marketing campaigns and plans that are very clearly targeted towards who you serve really well and running at that. So it's important that we look at each of these steps. We start from step 1 and then we go to step 5. And oftentimes I do see a lot of people that are kind of like stuck in step 4. And I think it's important to have we looked at and do we know, can we explain who the ideal member is? Then do we understand the size of the market? Do we know how to locate them where they are? Then we can look at how do we build the right strategy around our charter and our field of membership. And then it's okay, the real work starts to happen with making sure we are marketing to them and to specifically them. So how do you define your ideal member? So both of these buckets have to be true. They have to be profitable to your credit union. They have to be fueling the growth of the credit union. They have to have a profitable account mix. They have to have lower servicing and risk costs. They need to have a reasonable acquisition cost. And there has to be a predictable retention and product attachment model that you can follow with them. And then they also have to, this ideal member profile has to see a big benefit from choosing to bank with your credit union. So they have to be people that you genuinely have a positive impact on, where we can show that they are saving money on rates and fees by choosing to bank with your credit union, that they do have access to credit that they otherwise wouldn't get in other places, that the service model that you've built beats out a bank or a fintech alternative, and that there are long-term financial outcomes that are just measurably better, that you consistently remind and show to that ideal member profile. Again, if someone maybe has a lot of benefit but is not profitable, that's not your ideal member. And same on the flip side, they are very profitable, but you are actually not giving them a huge benefit. Those would not be people that we would categorize in the ideal member bucket. And again, build this entire marketing plan around and strategy. So sizing the market, here's just an example using Randolph Brooks Federal Credit Union. So total addressable market, this is going to be anyone within the geography that could possibly be a member. Then looking at the serviceable addressable market, that is, we have to take out net those structurally out of reach, which we always assume around 6% underbanked. And then for calculating the serviceable obtainable market, we're going to look at just assuming a 1-year obtainable share at 2.81% of the total addressable market. Then we would look at the members that you already are serving, and then that will get us what the percent of your total addressable market. And what I want to call out here is 26.7% is a high market share. So once you start to see your credit union above 25%, what that signals to me is, you've already served that total market really well. You actually have a very high field of membership market share. And so initially, some things we want to start talking about truly might be a field of membership expansion, getting you into more areas because you're already going to have such a high penetration rate that naturally, despite maybe having that be a high concentration of your ideal member profile, you've already brought in that ideal member profile, and it would be time to locate where they are in other areas. But same on the flip side of, if you start with a very narrow total addressable market, then again, you're going, growth and costs will just be higher with a very narrow field of total addressable market. So again, if you start very narrow, likely we want to talk about how can we increase your total addressable market. But then also, if you already have a very large total addressable market, but you've served it very well, and you're above 25% in your serviceable attainable market, that's another area where looking at your charter, looking at your field of membership is likely a very good thing to dig into. So then we got to look at locating where that ideal member profile is. One of the first things would be looking at a concentration of the ideal member, demographics. And so where are there clusters of this, and zeroing in on what those locations are. Then looking at predictive models by branch performance, right? Because you ideally want to be targeting areas that if you're going to make a big investment in service work and a service network and branching, it also has to deliver deposit and loan growth, right? That beats other baselines. And then you have to look at, okay, well, what's the competitive landscape with other fintechs, other banks, other credit unions? Who is serving that area really well right now? Can I compete with them? Can I not? Or is it green space where there's really not a lot of other banks or fintechs and maybe little credit union presence? That would be, like plan A, right? That is an amazing outcome. Then it would be looking at the field of membership feasibility. Based on your, if you're federal or state, your charter that you have federally, the field of membership that you have under that charter, are you already set up where you can move into that market and serve that ideal member profile? Or do we need to look at going through the process to unlocking the roadblock that you would have to being able to service that group? Why locating matters is really around the current consumer acquisition cost is about $565 for credit unions right now. We continue to see an increase about 15% year over year. And so not being very clear and knowing who you serve really well, you're going to be marketing to the wrong people and you're going to be spending a premium for the wrong people. And so if we're already spending a premium on consumer acquisition costs, ensuring that we are targeting who we know is profitable for us and who we serve really well, and finding where they are and ensuring we are where they are, we have a path to serve them, is just really no longer an option in the credit union world. And it's just extremely important because we are paying a premium. I'm sure all of you guys feel that when you look at marketing budgets. So reaching, again, this is more specifically around the actual field of membership, the mechanism in which you're able to serve and bring in new members. When we look at the last 10 years, so from 2014 to 2025, credit unions that did no type of expansion had, the slowest member growth, asset growth, return on assets, loan and assets. And then credit unions that did, again, we're talking like just a 2x expansion. So not even the largest expansions that have happened, but nothing too crazy, actually saw the best results, which kind of goes closely with likely having a very good understanding of ideal member profile, where they are. So not even expanding, in some crazy way, which we've done some of the largest expansions in the industry, but being very pointed with their expansion, saw a 4.9% member growth on average, saw an asset growth of 3.9%, return on assets of 0.78%, and loan to assets of 65%. And then credit unions that looked a lot larger, still had very good results with 4.2% member growth, 5.3% asset growth, and 0.9% on return on assets, and a loans to assets 70.6%. So this is looking at the last 10 years and understanding credit unions that did not do any sort of expansion, and then credit unions that did very large expansions, and then less than 2x, and very good results. And so it shows that just continue to look at the field of membership and look at expansion options will move the needle and impact strategic growth. But what's going to impact it the most is going to be, again, tying it back to that ideal member profile and ensuring each of the steps is woven in with who your ideal member profile is. If we look at the federal chartering mix, of course, you have your state charters, and then you have on the federal side 3 charter types that you could select. You have your federal multiple common bond, which currently right now is the charter type that most federals are at for 1,457. Then you have the federal community. So this is going to be, are you serving people who live, work, worship in typically a county or a group of counties or subdivision of a county? And then you have your single common bond. So this is your tip charters, they are tied to one segment, maybe one employer group or one associational path. And again, multiple common bond is a multiple of these things, right? You have your associational paths, you have your select employer groups, and then you have geographic rules through underserved areas. And then state charter types tend to have a blend of counties within their states, associational paths, or seg relationships. Something that constantly comes up, and I know is a barrier in the industry, but it's something that we all have more control over, is eligibility. And this is something when we ran the consumer perception report, 40% of consumers don't really understand eligibility or find that is a big friction point. And when we look at abandoned applications, about 84% drop off at that validation step, which is typically pretty early in the application process. Some other barriers that consumers have, which are a little bit harder for us to control, is ATM and branch access, mobile app quality, and then just not knowing enough. But the eligibility confusion, working to, go through the how are we marketing and explaining our eligibility on our website? How are we ensuring frontline staff at branches deeply understand our field of membership and eligibility? And then, what does that workflow look like in practice with our account opening systems? Those are things that we have control over to support providing more clarity to potential members that are looking to join a credit union, and ensuring that we're doing the best that we can to remove that friction and put the work on your technology and your staff versus putting the work on the American consumer to try to understand how they're eligible, and maybe going through a drop down of like hundreds of potential segs or a bunch of different counties. Making it as invisible as possible or frictionless as possible is something that we have control over, digging into and finding better solutions for. Looking at the market, and so marketing to them. And something that we just at CUCollaborate constantly see when we look at what are the drivers that clearly show if you spend more time here, you're going to have a clearer impact on your assets positively, constantly is actually spending more on your marketing budgets. So dollar for dollar, we see 7x more asset growth per marketing dollar. And so if you're thinking about, do I look at deposit rates? Do I look at increasing more of the marketing budget? Consistently, we see that spending more in the marketing budget, you'll see at least 1% lift if you lifted by 1% that year. But if you did a 7x, you would see a 0.8% annual growth just by allocating more towards the marketing budget. And if you follow this framework and you're, again, allocating these dollars towards who that ideal member profile is and building marketing campaigns to reach that specific person, you are going to see a major positive lift. We have built out different prospect personas. So we've got the digital native, that is about 37% of American consumers ultimately wanting better rates, but a huge barrier for them is they really want to make sure that the tech is there for them, and understanding eligibility, making sure it's a very seamless process when they're going through digital banking or mobile app. Value seeker is about 36% of prospects. They're wanting lower fees, and for them, eligibility, but also mainly like awareness of the value that they would be getting from credit unions. Community connector is about 28% of American consumers. They want better rates. For them, convenience, so potentially, not being close enough to a branch, not being close enough to an ATM. Those could be things that could be a barrier for someone that is a community connector. Retirement planner is about 28% of prospects. They're really seeking better saving rates. And for them, the biggest barrier that we find is ATM access. The affluent achiever is about 18% of prospects. They're also seeking better rates, but they're seeking better service. And so for them, convenience, type to service, and app can be barriers for potentially why they're not banking with a credit union. When we look at the perception gap and how to close that, it's very clear that members know that it's very good, and prospects might just not be believing it yet or have had that experience to know how good it can be. So when we look at members agreeing and prospects believing good mobile banking, this is actually the one that has the biggest gap. So members will say, actually, no, like I, for the most part, have good mobile and online banking experiences. And then prospects are, behind on knowing that that's available to them if they work with a credit union. And that's a 35% gap. Convenient for ATMs, you've got 70% on members agreeing, and then you've got 42.9% for prospects. So that's the second biggest gap at 27 points. Lower fees at banks, you already see consumers being, at that halfway mark where a majority of them do know that that's a fact with credit unions. And then you have 75.8% of members agreeing with that. Better rates, you have 72, and then 51.5%, almost similar to lower fees than banks on the prospecting side. And then trustworthiness, that's where you have the lowest gap with 66.4% of prospects believing that, and 78.1% of members agreeing that. So really here with marketing, it's correcting false assumptions around tech experiences and convenience, and highlighting where that's not true specifically for your credit union when you're marketing to the ideal member, because that's ultimately like the biggest gaps that we have with American consumers and having them join credit unions. So the cheapest growth lever that you can initially act on now is really retention and culture at the credit union. So 90% of current members have a very positive impression, with 39% reporting zero concerns at all. So really digging into the fact that, you know, members have a very positive experience with their credit unions, and investing in lifestyle marketing and having a very clear next best product vision for your ideal member profile, you know, having persistent pre-approvals, being very competitive with your digital banking and investing in that area, having structured member referrals. And then the big thing that is huge at CUCollaborate that we work a lot with our clients on is really know your member data, use that Aries information, be overlaying that with also your call report, and be asking the data before you're just guessing. You like weave it into the strategic conversations that you're having, and, you know, understand who the ideal member profile is, understand the data before you're making major business decisions. On the employee side of your frontline staff can be a huge differentiator as well. So 37.8% of members say that service is a huge reason of why they stay. We know with many of our clients that they have extreme loyalty to certain branch locations as well. And so ensuring that everyone who's at the branch, they understand your eligibility rules and how to communicate them, that they're also seen as a trusted advisor for financial wellness and coaching advice, that they themselves also deeply understand who that ideal member definition is, that they can pinpoint that as their, you know, people are walking in to join the credit union or conducting business with the credit union, that you're tying incentives to member outcomes versus just transaction outcomes, that there is that referral program that activate your members, and then treating MSR retention as growth metrics and not just an HR metric. Then, of course, you know, the big thing that has probably been weighing on everyone's mind too is just the Gen Z question, and how do we find ways to bring Gen Z into credit union membership? Because right now, about 16% are primarily banking with a credit union, and 48% of Gen Z are at a national bank. And when we look at the older generation versus Gen Z's positive view on credit unions, it's actually Gen Z holds a minus 22% positive view than older generations. And so really with Gen Z, there's an information gap, and about 22% say that they don't know enough about credit unions, and 20% say that eligibility confusion or difficult to sign up is a reason why they're not currently banking with the credit union. And so again, these are barriers and, you know, communication gaps that can be solved, versus, you know, a very big negative view or having to structurally change how you operate to be able to serve Gen Z. It's more about awareness and marketing and communicating and ensuring that internally at the credit union, we're making eligibility as seamless as possible and easy to understand, and not a reason why someone is not signing up. And then investing more in marketing so that perception and awareness of credit unions can go up, and that people are getting more knowledge about credit unions. And then some opportunities that I always love to highlight for credit unions would definitely be, you know, if you are looking at your ideal member profile and you find that they tend to be in as NCUA's low income designated areas, or they tend to be an underserved population, if you do a lot of, you know, lending to lower tiers of credit, I would urge that you, if you're not already, be considering CDFI certification. You can access amazing grants that can help really continue efforts and fund how you're serving that ideal member profile. The financial assistance award is for up to $1 million. The technical assistance is for up to $150,000. The small dollar loan program, which just wrapped this July, is for up to $500,000. And then on the flip side, NCUA's low-income designation is a really great program if you want to remove some of these regulatory barriers. For example, if you're looking at removing the member business lending cap, this would be a great program to consider. If you want to be able to accept non-member deposits, again, I would have you consider the low-income designation. There are grants, they're called CDRLF grants. They're the most it goes up to is 50,000. I would say if you are a mid to smaller size credit union, that would be something, another benefit for the low income designation. You can also go after subordinated debt. And so again, low income designation is not something that's really member first. It's not like a marketing ploy. It's much more about the, what you can do, the regulatory relief that you can have from being a low income designated credit union. And then CDFI certification is managed through the Treasury Department and is all around accessing the grant funding that exists out there. There's way more in both of these programs. So if these are things that are on your radar or you're struggling with or you have interest, we can schedule time to do a deep dive that's going to be very specific to your credit union, where you are geographically, and maybe for CDFI really what your lending looks like. So big takeaway is don't be everything to everyone, be indispensable to someone, be indispensable to that ideal member profile, define and with confidence know who that ideal member profile is. Again, they have to be profitable and beneficial to they have to be profitable to you and you have to be beneficial to them. Locate where they are, look at total addressable market, serviceable attainable market, serviceable adjustable market. Use Guild membership as a mechanism. Don't worry too much about, we don't have the ability to serve them now. There are ways to look at your charter and Guild membership. There are avenues to getting you into the markets that have your ideal member profile. And just always keep top of mind that eligibility is a major friction point, but it is a very fixable barrier. And then invest in marketing, market like you mean it. Know that 7x more growth per dollar than you would see if you spent that on raising deposit rates. And then where you can start. So for people who are CUCollaborate clients or even not, a lot of this you can either do with us or likely many of your vendors can support you in running a profitability by segment cut. So if you pool 24 months of call report data and especially core data, Aries data, group those things together and look at the members by tenure, by product mix, by household income, and understand which of those segments are truly funding the credit union. Calculate your TAM, SAM, or SOM, look at that and understand, are you above 25% of your total addressable market? Are you well below that? Is there a narrow problem at the beginning of your total addressable market? Or is there, we've actually served it really well, we've grown really well, now we need to consider where else does that ideal member profile live? Or in our total, our current total addressable market, our ideal member profile actually isn't in there, and we need to look at expanding into the areas that they are. Map your ideal members against your footprint. So where do they actually live and work? Overlay that against your branches, your ATMs, different banks, different credit unions, different fintechs, and then gap between the map and your strategy. And then audit your application flow for friction, right? Like have someone recently gone through the process of joining the credit union to see how much time it takes, or how easy is it to follow the field of membership rules and select how you're eligible, or have we already found a way to make that invisible with your other vendors? Are we struggling to teach the frontline staff on how to talk about eligibility, and they themselves deeply understanding it? And then go back to that ideal member profile and build campaigns that target them, that are seeking to reach them, that are going to resonate with that ideal member profile. All right. Well, that is it for today. We can quickly run through, I'll keep these up on the stream of just like upcoming webinars that we have, but we can open it up for questions.
Fantastic. Thank you, Coco. We do have a couple questions already coming through the chat, and then that'll also give us time for others to think of and put their questions in the chat. So the first question, we may need a little bit of a clarification around this, but Jennifer's asking, how do you recommend selecting an audience with regulatory considerations for targeting on demographics in the lending space?
Regulatory considerations for targeting demographic. Is this kind of like we want to make sure we can follow the regular, like, for example, if you're a state charter credit union, like knowing that you can comply with things that might be outside of your
I
regulated
think
state.
Jennifer did provide a little bit of a clarification
Okay.
in the chat here. Sounds like Jennifer's looking at like how would you recommend selecting who the ideal member is? They're
Yeah, I
looking
mean,
at that.
for selecting who the ideal member profile is, this would be, so digging into, if you're looking at I would look at the areas data and pull out who has again, like multiple different products with the credit union, who, was not the highest cost of customer acquisition for us. And then, looking at, do you know how much your credit specifically has saved them? So something at CUCollaborate that we help our clients quantify is what we call the risk-based member benefit pricing. So it's actually attributing a dollar amount to each individual member of how much they have saved by choosing to bank with your credit union. And then we want to look at, is there a group of those members that seem to all fall on a certain number? And you can think about like, what is the right, is it $200? Is it $100? Like we'd have to kind of dig into your specific data, but like pulling out where we see themes of members that, have a diverse product set, that we also see a healthy amount of money that we save them per year. Do they have a similar credit score? What are the similarities across the members that initially are profitable for us? But on the flip side, we see like a clear, like we are benefiting them and there's like a clear alignment between our fiduciary duty back to them. For Jennifer, I will send you to a blog that we've written in detail on our risk-based member benefit pricing analysis and how you can start to look into doing that.
I think, and since your answer there, Jennifer also provided some clarification. Yeah, around this is a question that we often get from credit unions, specifically in the lending space. Of, hey, we really want to serve this segment of our membership, but we also want to be considerate of fair lending laws that exist and regulations that might bar us from overly targeting a particular segment of our membership. Anything that you can elaborate on there? Otherwise, I can also provide some follow-up for Jennifer on that. Do you have any other considerations around the
Is that for Ben? Is that a question that you were pointing at towards me, or was that for Jennifer?
For you.
Okay. I would say that I would want to look, Jennifer, at your specific credit union and kind of like where you're like, I think it's going to boil down to credit union. At least what I would say would be, I would want to look at like your field of membership, your credit specifically, and kind of where you're like, what are the areas that you're looking at before I would say something that would be like a blanket statement for everyone. Because I think it's so dependent on like geographically where your credit union is and how you guys operate.
We'll be following up. The next question that we have is from Mark. And his question is a focus on indirect lending typically a feasible strategy for member growth and brand awareness into new markets through a multi-common bond charter?
So it's difficult. Indirect auto lending or indirect lending, typically what I have seen is that you get them in, but you oftentimes don't really grow them. Or if you don't get them interested in a broader relationship as soon as possible, you're typically not going to see them grow with the credit union or pursue other products and services with the credit union. And so again, like it's great to do indirect lending, but I would still have a big focus on, again, like knowing who your ideal member is. And if you have like open association routes to membership and you have a very broad ability to, bring people in, that is good. And that will always be very good and indirect. But if we're looking at like lifetime value and again, like who's going to have a more diverse product set, I typically don't see that with indirect lending.
We have a question coming in from Janice. Do you offer the service or program to help us identify who our ideal member is?
Yes, we can definitely support people who are interested in quantifying and understanding and identifying who their ideal member is. We take call for data, ARIS data, and support you guys in pinpointing who that is. So yes, and you will all have access to the slides as well. So there was a lot, like one of the last slides gives a good of like kind of how to start segmenting those out. And of course, hope whoever was listening versus taking notes, so you'll be able to pull those slides back and dig into them.
See any other comments or questions coming through the chat? I'm going to post a couple updates here in the chat. There are some links respective to the conversation here today. One, you can actually download the strategic growth framework. Since you are an attendee of today's webinar, you can go ahead and click if you want to on the link in the chat. It'll bring you to that framework, and as an attendee, you can download that without any other need to submit your information.
People are interested in the 2026 Consumer Perception Report. That is also accessible on our website too. So a lot of the data I was sharing came from that. So I would recommend if people are interested to download that from the website as well.
All right, I don't see any other questions or comments coming through the chat. I'm just going to pull up my screen just really quickly here. We do have 2 more webinars coming up in the near term. Next week we have, and this is actually related to some of the things that Coco was talking about. The NCUA recently updated the Low-Income Designation workbook that they publish on their site. We're going to walk credit unions through the changes and updates that were made and how that affects your credit union, whether you currently have the Low-Income Designation or if you're seeking or interested to learn more. Please do join us for that. I did drop a link to register for that webinar in the chat as well, but you may also use your phone and scan the QR code there to register. I'll just pause for a moment if you want to do that. And I will note that yeah, the workbook does change, and so we are finding that it can be beneficial for some credit unions. Oftentimes it is an update that is unexpected and as a result can potentially change and often does change your percentages. So definitely whether or not you're able to join us, be mindful of that. And then we recently launched a what we're calling the quarterly download. It is a review of something that Coco mentioned at the top of the hour here, credit union mergers. We know that the number of credit union charters are vastly and rapidly diminishing, while new credit unions are slow to come. And so we do now a quarterly review of merger trends and updates around what's happening in that space. Would love for you to join if you're curious to learn more about what's happening in credit unions on that front. That is Wednesday, September 23rd at 2 p.m. Eastern. Again, you can either link out to that in the chat or register here. I'm going to leave that up and just say thank you so much for joining us today. Thank you so much for the information, Coco. We'll follow up with recordings and slides here after today's call, and appreciate you spending your afternoon with us. Thanks, everyone.
Bye, thank you.